Okay, thanks very much, everyone. We've got quite a few people have joined us, so thanks very much for taking the time to join us. I'm Anthony Turner, CEO of BlockDAG. This evening I'm joined by Dr. Maurice Hurley. He's going to be talking about automated market makers. I'm going to explain that, a core part of DeFi, something that underpins how DeFi works. So he'll be taking us through that. If I can just start with an introduction for Dr. Hurley. So Dr. Hurley has an AB in mathematics from Harvard University and a PhD in computer science from MIT. He's also served on the faculty of Carnegie Mellon University and the staff of the DC Cambridge Research Lab. So we're very fortunate to have him as an advisor to our project, and having him here this evening talking to us all. Just to recap, so Maurice spoke, he did the first technical session last year, and he introduced everyone to the DAG, how it works, the mechanics behind it, the benefits in terms of a DAG versus a traditional linear blockchain. That session is recorded. You can find it on YouTube, on our YouTube channel. Very interesting and obviously relevant to BlockDAG, given that that's exactly what we built on top of a DAG. So I certainly recommend go and have a listen there. It's very interesting. It gives you a good and understandable breakdown of how the DAG actually works. He also spoke a couple of weeks ago about EVM fees and gas fees, something which I took for granted as being probably thinking that it was fairly simple, but in the reality, it's quite nuanced. And it's gone through changes over time, as well as EVM and crypto and blockchains have changed as well. So again, that's also in our YouTube channel, so worth having a listen to that. Last week he was supposed to introduce us to automated market makers. He had some technical difficulties, unfortunately, so that didn't go ahead. So that was pushed out to this evening. So he's going to be taking us through that. So yeah, I think so what he's going to cover is really the AMMs, in terms of how that underpins DeFi, how it's used, how it works in terms of smart contracts, etc., liquidity pools, the benefits of them. He'll possibly cover different algorithms that underpin them in terms of the mathematics and how they work. But I think rather than me trying to introduce it, I think it's probably better that I hand over to Dr. Hurley. So yeah, he's going to take you through it. Sit back, enjoy, and then we'll have time for questions afterwards. So stick around if you've got any questions. Just to mention, it's a technical session. It's not meant to cover what we've built, or it's not meant to cover BlockDAG tech specifically. So it's fairly generic. It's about AMMs in a broader sense. Obviously, AMMs are relevant to BlockDAG in terms of the DeFi that we're busy building, but from Dr. Hurley's perspective, this is a generic, general discussion. So yeah, if you can bear that in mind, and obviously questions later again is more generally around AMMs and DeFi. Anyway, that's all from my side. So thanks very much, Dr. Hurley. If you want to take it over, thanks very much.
Thank you for that introduction, Anthony. So today we're going to be talking about one of the largest and most vibrant applications of blockchain technology, which is decentralized finance, which everyone calls DeFi. So the idea here is that we can take the kind of higher level financial protocols that people do in real markets and stock exchanges and do them on blockchains. And as we'll see, this has a number of advantages. And it also, it's the nature of blockchains that we can make financial products that could not have been created, or at least not easily created in real life. So we're going to talk about what you can do with networks of smart contracts built on blockchain that run finance. Now, as Anthony said, the goal of this talk is your general education and entertainment. It's not a talk about BlockDAG specifically, But we know that there are members of the BlockDAG community that are enthusiastically working on porting various DeFi protocols to blockchain. So we anticipate that someday soon, BlockDAG, after it goes live, will be the go-to place to do a lot of DeFi. Now, the way to think about DeFi is programmable money. The smart contracts can control the flow of money. The programs that govern the smart contracts are the actual program. Now, I don't have time to talk about all of DeFi. I could spend a month on the topic. It's enormous, and there are many things that are happening. So I'm going to start with a very simple and elementary problem. Here we have your typical BlockDAG user who wants to trade some tokens, some florin tokens for guilder tokens. Now, as many of you may know, florins and guilders are obsolete European currencies. It's also a shout out to one of my favorite movies, but you can think of these as Bitcoin and Ether, any pair of tokens that you like. Now, if you want to trade some of your florin tokens for guilder tokens, you want the trade to have what's called good liquidity, meaning that I don't have to wait around much for my order to be fulfilled. So if I can sell these tokens instantaneously, then I have good liquidity. If I have to sit around for a week checking my phone all the time, then that's poor liquidity. But liquidity is a term of art that you hear a lot. So I wanted to put that in there. The user also wants low slippage. So slippage occurs when buying a token changes its price. So some markets have low slippage. If I buy an apple at the supermarket, that does not change the price of apples in my city. But if I go out and I buy 1 million shares of Apple stock, then that might well change the price of Apple stock. So one way to measure slippage is to say, is the cost of the first unit that I buy the same as the cost of the last unit that I buy? And of course, the user wants low slippage, meaning that they don't upset the market and drive up prices by the simple act of doing the exchange. Now, there are a number of ways on the blockchain to exchange assets. The most obvious and probably the most widely used and the most convenient is a centralized exchange. This would be something like, Coinbase. I can go to Coinbase, I send them some USDC, and they will cheerfully send me back, Bitcoin, Solana. Someday they'll send me BlockDAG. And this is extremely convenient. I can summon it up on my phone anytime I feel like it. You have good liquidity because for most things that you want to do in a centralized exchange, they will respond pretty quickly, because the exchange makes the other half of the deal sometimes. So slippage, unless I'm a whale, if I go and I buy a handful of Bitcoin on Coinbase, that is not really going to affect the price of Bitcoin in any way that anyone can measure. At least the reputable exchanges are secure. They're compliant with regulations in their country, so you don't have to worry about inadvertently violating laws. They will do know your customer, anti-money laundering, everything you need there. So in many ways, centralized exchanges are an attractive way for our hypothetical user to trade the florin and guilder tokens. Now this is one side of the observation. The other side of the observation is that centralized exchanges have a history of running away with your money. The first such was the famous Mt. Gox, where actually nobody really knows what happened to the Mt. Gox money. There are rumors that it was stolen by the Russian mafia. There are rumors that it was stolen by the people running the exchange. There are rumors that it was lost. There are all kinds of mostly baseless stories about what happens. But the problem with centralized exchanges is that they're centralized, and you have to trust people who are perhaps not deserving of your trust. So this brings us to the alternative, which is exactly the reason that many people and institutions are attracted to blockchain, which are decentralized exchanges. Now, before we talk about decentralization, let me talk about different ways that you could set up an exchange. So here is the traditional exchange that is mostly in use in stock exchanges and currency exchanges today, non-blockchain exchanges. This is called an order book. So the market maker has a list of offers. So here we have offers. Someone is willing to sell guilders, a particular number of guilders at a particular price in florins. So the first entry says there's somebody who's willing to sell 1 guilder at 1.21 florins. Someone else is willing to sell a guilder at 1.23 florins. And then there's someone who's willing to sell 10 guilders at 1.26 florins each. And these are sorted by price. So now our customer comes along and says, I want to buy 3 guilders, and I don't want to pay more than 1.25 florins for each gilder. And so when you come to the exchange, what they'll see is, well, the first 2 guilders are sold because the asking price, their asking price is less than the price that the customer is willing to sell. The third guilder, though, can't be sold because they're asking 1.26, whereas the customer wants 1.25. So the order is partially filled, and the customer now can sit around and wait to see if someone else posts a sell offer that is within range. So the slippage here is the amount that the amount by which the purchase has moved the price. So the slippage is the price difference between the first guilder at 1.21 and the last one at 1.23. So this is a non-trivial slippage. Liquidity is poor because the customer is still waiting for the third purchase, and the customer has no idea how long they will have to wait. The customer could give up. The customer could decide that they're willing to pay more, but this is not instantaneous, instant gratification. So this leads us to automated market makers, which are called AMMs. Now, an AMM is an invention that could only exist on a blockchain. It relies on smart contract technology. It, in some sense, explains why you need blockchains to do finance, because something like an AMM could not realistically, it would not make sense to try to implement an AMM on in a regular kind of environment. So what I'm going to describe is a set of basic principles. I'm going to skip over a lot of technical details, mostly things that aren't interesting at the high level. Most of what I say is going to be based on Uniswap v2, and then at the end I'll mention some of the improvements in v3. So, but what I'm trying to focus here on things that are common to all AMMs on the market. So AMMs right now are a big business. Uniswap is certainly the biggest and most popular brand of automated market maker. There are literally dozens of others. I should update the slides and put in their logos, but there are lots of AMMs. They all differ in minor ways, but the part that I'm going to talk about today is pretty much common to all of them. So the idea here is we're going to trade between two or more liquidity pools. What is a liquidity pool? A liquidity pool is just a pile of money or a pile of assets, a pile of tokens. So there's a smart contract that manages two piles of money, which we dignify by calling liquidity pools. And then using a mathematical formula, you can trade between them. And the advantage of this, before I explain how this is done, there's no waiting for the customer. The customer gets a straightforward take it or leave it price. There's no uncertainty about whether the offer will be taken. Because it's decentralized, running as a smart contract, theft is impossible. The smart contract code is there to inspect. You can check it for bugs. You can run your formal verification on it. You can unleash your AI to check it. But you can be quite confident that no one is going to abscond with your money, unlike in the centralized exchange. It's also convenient. Presumably, this isn't a showstopper for most of you, but there's no need for Know Your Customer AML. You don't have to take a picture of you holding your passport, and you don't have to text it to somebody in Kuwait to check your identity. Now, who pays for all of this? Well, an automated market maker is for the liquidity, that is, the assets are provided by people called liquidity providers. So liquidity providers lend their assets to the pool. So if I want to have an AMM that trades between florins and guilders, I can take a pile of florins and a pile of guilders, and I can lend them to the AMM, and the AMM will use them for trading purposes. In return, what I get are shares in the AMM. These are tokens of a type that say that I own a certain amount, a certain share of this AMM. The exact structure of these shares varies a little bit from AMM to AMM, from company to company. But basically, they give you the right to earn fees. So every time someone does a trade on an AMM, they cough up a small fee. Those fees are eventually distributed to the liquidity providers. They give you governance rights. The AMM may decide to raise its fees, it may lower its fees, it may decide to replace one token with another. You get to vote on this in proportion to the number of shares on the AMM that you have. And usually, you can add or remove liquidity at will. Sometimes there may be a fee. So if you're sitting around figuring out how can I derive some benefit from my from a pile of assets, one option that you have is you could become a liquidity provider and lend your assets to the AMM. You will acquire fees. You will have the opportunity to direct the governance of the AMM. And anytime you want, you can remove your fees. You can remove your liquidity from the AMM. So now we'll get into the mathy part. I don't want anyone to panic because I'm going to describe this in very elementary terms. There's really not much math going on here. There's a little bit of notation here because sounding things out in words would be kind of cumbersome. But the idea here is that, remember, the AMM manages a pile of guilders and a pile of florins. So something called a constant product AMM, which is the simplest kind that we're going to spend most of our time talking about it, has the property that if you take X, the number of guilders, and Y, the number of florins, and you multiply them together, that's a constant. In this case, in the picture I've shown you here, the product of the two is 1, which would be kind of a silly number in practice, but I'm going to use it because it makes the presentation flow a little bit more smoothly. So the idea here is that there are two liquidity pools. the pool of guilders and the pool of florins. And the state is how many florins you have and how many guilders you have. And all the possible states for the AMM lie on this curve. And we'll see that the shape of this curve is very important because it determines the economic and trading behavior of the AMM. So, we can have a lot of fun talking about how changing the curve would change the behavior. But basically, all the possible combinations of guilders and florins that can happen are exactly the points on this curve. So we can rewrite this and say, the number of florins is 1 over, the number of guilders is 1 over the number of florins. So one possible state we could have is that the AMM might own 2 guilders and 1/2 florin. And we know that's a legitimate state because if we multiply the 2 of them together, we get 1. So we have 1/2 florin, 2 guilder. The state lies on the curve. That's a legitimate state that the AMM could have. If instead we had, say, 3 guilders and 1/2 florin, that would not be a legitimate state because that would not lie on the curve. And the AMM would never be allowed to enter that state. The smart contract that governs the AMM would not permit that. Okay, so remember AMMs exist to do trading. So let's say a trader comes along and wants to convert 1 florin to guilders. So what it does is it goes to the pile of guilders, in this case 2, or it goes to the pile of florins, the 1/2 florin, and it puts in 1 florin. So now the AMM is imbalanced. It's gone off the rails. We now have too many florins for not enough guilders. So the contract that governs the AMM now has to basically put the AMM back on track. So it has acquired 1 florin, and to get back on track, it has to release 4/3 of a guilder. So in return for 1 florin, the trader gets 4/3 of a guilder out of the AMM's liquidity pool. And that takes us back to a state where we have 3/2 florins and 2/3 guilders. And you can see if you multiply those together, you get 1. And so you can see how the curve of legal states in the AMM determines how many guilders you get back for putting in a florin. So we keep, we keep this property, this invariant, unchanging property, that the product of the number of guilders and the number of florins is 1. And so no matter how many florins you put in, we can use that formula to calculate how many guilders to put out in order to restore the balance. And of course, we can go the other way. We can put in guilders and take out florins. So as a side point here, each trade incurs fees. So in addition to, when the trader puts in 1 florin, they probably put in 1 florin plus change as a fee. And the fees are eventually paid to the liquidity providers. In fact, the fees are pretty much why the liquidity providers do this in the first place, because that's how the liquidity providers make money. So Uniswap, for example, is 0.3% on every trade in either direction incurs a 0.3% fee. So back to AMMs. Now, you might say, well, how does the AMM know what price to charge? What is the actual price? So what can happen is suppose an AMM is diluted about the actual market price. So here, the yellow dot is the AMM's current state. That blue dot is where the actual market thinks that the AMM should be. So the exchange rate that you would get if you were the blue state would match the external market state. So what you can do is, if you happen to notice this, you can do what's called arbitrage. So I look at this and say, it looks to me like, florins are highly undervalued here. So I can buy the undervalued currency from this AMM and sell it on the actual market and make a risk-free profit. So the arbitrager profits by selling the undervalued currency in return for the overvalued currency. And remember that when you buy or sell something on an AMM, you change the price because you move the point around. So it turns out that the arbitrager maximizes its profit by setting the AMM price to exactly the market price. We're assuming here that everyone knows what the market price is, which is probably Coinbase or Kraken or any of the major exchanges say it is. So this has the interesting property that AMMs are likely to be pretty accurate in terms of the exchange rate that they provide, because if they're not accurate, an arbitrager would have gone in and fixed it. So despite the fact that AMMs don't need fancy oracles or anything like that, they are highly likely to give you a pretty fair rate of exchange, because any unfair rate of exchange would have been eliminated by an arbitrager. So AMM prices are self-adjusting. So this is a good thing for customers of the AMM. It's a little bit more of a mixed message for the liquidity providers. So as I said earlier, AMMs don't know the current market rates. They're just dumb smart contracts. All they can do is they know how much, they know the sizes of each liquidity pool. They know the rule for exchange rates. The rule for exchange rates depends on the sizes of the pool, but they don't need to know the exchange rates because outside arbitrageurs will ensure accuracy. And again, this is good for customers because customers can be reasonably sure that they will get a good rate. But there's a little bit of a fly in the ointment, and that the reason the arbitrageurs do this is because they make a profit. Where does this profit come from? Who pays for the arbitrageurs' profits? Well, the answer is the LPs pay. So the LPs put in their assets at one exchange rate. When they take out their assets, there's a different exchange rate. And the arbitrageurs are the ones who have benefited from the change in exchange rates. So if prices are relatively stable, then the liquidity providers have a pretty good deal. If prices are volatile, then the liquidity providers need to worry that arbitrageurs are going to diminish their profits. So this is why, for example, AMMs that trade volatile currencies will tend to have higher fees than AMMs that trade, for example, stablecoins. Since stablecoins are relatively stable compared to each other, you can charge very low fees. But if you're trading meme coins, then your fees will be higher because the risk to the LPs of large price fluctuations will be higher. Okay, so we talk a lot about price, and the price of a purchase is something we can drag out of the curve. So here, the trader puts in DX florins and gets back DY guilders. What's the price? What's the ratio of how much the investor put in to how much they got back? And so that's the purple chord on this picture, which goes from the initial state to the final state. The slope of that chord is the ratio between the input assets and the output assets. And that's the price of that particular purchase. And as you can see, the price depends on the size of the purchase. So we're interested in what happens in the limit. This is called the spot price. another term of art. So the spot price is how much it costs to buy an infinitesimal amount of something that might have a slippage. So usually when you see, price of Bitcoin or something like that, that's the spot price. So if you buy 1 Bitcoin, you're going to pay the spot price. If you're going to buy a million Bitcoin, then you will not pay the spot price. You'll probably pay something higher. But in this case, we can define the spot price as the slope of the tangent line, that is the derivative. Technically, it's the negative of the derivative, but never mind. So here we have this nice property that the slope of the curve tells you what the price is. So you can see if there is a very small number of florins and there's a large number of guilders, florins will be very expensive, will be relatively expensive, and guilders will be relatively cheap. If we go in the other direction, the florins will be cheap and guilders will be expensive. So you can see the slope approaches infinity as we push the dot toward the origin. It approaches 0 as we push the dot away from the origin. But it never actually, of course, reaches 0 or an infinite slope. Now, there are dangers here. I'm going to describe the, one particular kind of attack that can happen. This typically only affects people who are making very large purchases, but it's worth understanding what's going on. This is an attack that's kind of as old as time, which is called front running. This is something that happens on the regular stock exchanges all the time, although it has a particular flavor when we look at it here. So here we have another customer, this little red demon on the left, and it wants to put in 1 florin and buy guilders with that florin. So the customer looks at the curve and looks at the current state and says, okay, so we're in a state where there's 1/2 florin, 2 guilder. I'm going to do my calculation. If I put in 1 more florin, I should get 1 1/3 guilders back. And our customer says, well, this seems like a reasonable deal. This is exactly what I need to finance my vacation. So I'm going to do this. Then, of course, the internet being the internet, this request is delayed. So it goes into the pool of requests, and for some reason, it doesn't get delivered for a while. Now we have the attacker. The attacker sees this request sitting in the pool that has not yet been acted on, and the attacker launches a front-running attack. So the attacker immediately puts 10 florins into the AMM. So this is a large amount of a large number of florins compared to the current status, compared to the current pool size. And in return, the attacker gets back 1.9 guilders. Now, this changes the price. Remember slippage. So if you put in lots of coins, you're going to change the exchange rate because you're going to move the point on the curve far from where it was, and the slopes are going to be different. So in this case, when the attacker deposits its assets, it moved the state from the yellow dot to the green dot. You can see that the slopes of the curve are quite different. When the original customer's order is serviced, it gets back only 0.0082 guilders instead of 1.333 guilders. So that is a lot less than it was expecting. But legally, this is perfectly okay. It's just that you might naively think that this was because the customer was unlucky, but of course we know that luck has nothing to do with this. So to summarize, what happens is the customer says, I'm going to put in 1 florin. I'm expecting 1 1/3 guilders back. The attacker puts in 10 florins, gets 1.9 guilders back. The customer is puzzled because they get a small amount of guilders. And now the attacker takes the guilders that they got and puts them back. And what happens, what they get back is 10.9, basically 11 florins. So the attacker made an extra florin in a risk-free way by front-running the other customer's purchase. So if you can lurk around the pool of trading requests, slip in your order in front of your victim's order, and then after your victim has executed their order, basically do the inverse, then you can make money in a risk-free way. Now, as I mentioned before, this is a threat only to entities that do large trades, only to whales or semi-whales. For most normal traders, front-running attacks aren't going to make any sense because the cost of the fees will eat up the attacker's profits. So this is something that can only happen. This is only worth the attacker's while if you're a whale. So in this case, though, the customer got lots fewer guilders than expected. The bad guy got a lot more. Now there are all kinds of mechanisms that can be used to protect yourself against this. For example, most AMMs, you can, when you place an order, you can put in slippage limits. And you can say, I want to do a trade, but if it turns out that the price has changed by more than 5%, then call the whole thing off. So there are ways to protect yourself against this. But I think it's important to understand the principle here because there are many more complicated, more sophisticated attacks that are based on this principle. So most of these attacks have a very kind of simple core property. There are bells and whistles and complications on top of it in real life often enough. But if you understand the basic patterns, then it becomes easier to understand basic threats. Sorry. Okay, and in fact, this does happen. There are bots out there that will, that lurk around and look for opportunities. Again, this isn't an existential threat because right now AMMs are multi-billion with the B dollar business, and people would not be using them so much if this was an everyday occurrence. But again, this is still something that's real. So let's talk about kind of the properties that make people love AMMs so much. So the way I'm going to structure this story is I'm going to talk about this curve. This is sometimes called the binding curve. You might hear that term. And the binding curve that I showed you before was this hyperbola where if you multiply the number of guilders and florins together, you get a constant. Let's replace that with an arbitrary function. And it turns out that there are many, many functions we could plug in there, but they're all going to look pretty much alike. And we'll investigate why that is. So question is, what should the curve look like? There are AMMs that specialize in stablecoins. They use slightly different curves because AMMs don't have much slippage. There are AMMs that have slightly wilder curves and so on. So one thing you can say is, well, could that curve be a straight line? So that's an AMM where the price, remember the price is the slope, is constant. So this AMM will sell you 1 guilder for 1 florin no matter what. Now, if you think about that for a second, you can see why this is not going to make the liquidity providers rich. It has a great advantage that there's no slippage. No matter how much you buy, you don't change the price. But the problem is if the external market price changes, then suppose the external market decides that 1 guilder is worth 2 florins, then arbitrageurs will instantly flock to the AMM, empty it, and that doesn't, and one pool will be emptied, and the liquidity providers will end up losing a lot of money. So nobody wants an AMM where the curve is flat. Well, one thing we also want is that the price shouldn't change abruptly. The pool sizes shouldn't change abruptly. You don't want things running along smoothly, and then suddenly everything changes just like that. So that just says that the curve should be continuous. That is, the state shouldn't instantaneously go from one point to another point that's far away. So from the common sense notion that pool sizes should change gradually, not abruptly, we can get the kind of mathematical idea that when we draw we should be able to draw this curve without taking the pen from the paper. We also don't want the prices to change abruptly. Before I was talking about the pool sizes, but here I don't want to say that if there's a very small change, a very small purchase will set off a very large change in price. What we really want is we want these prices to change gradually, even as the pool sizes change gradually. So that says that the curve should be smooth. We don't want any corners on the curve. There's some, common sense things. It wouldn't make any sense to say if I add florins that creates more guilders, which means that the curve should be strictly decreasing. Here I have a picture of a curve that looks normal until you get far enough out to the right, and suddenly it zips up. And the way to interpret that is that if I put in florins, I also need to put in guilders in order to keep the point on the curve. And that clearly makes no sense. This would be an extremely weird AMM, and nobody would invest in it. So that just says that the curve had better be strictly decreasing. A curve is convex if all the tangents on the curve lie below it. So what we want to say is that the AMM cannot yield better than market price. And what that translates into is that the curve should be convex. Because in this picture, I show you a curve that is not convex. You can see here that somebody puts in a florin, that's the horizontal arrow, and what do they get? Well, what they get is the size of the downward green arrow, but the downward purple arrow is actually how much they should get at the market price. And so here the AMM is by construction paying out more than the market price. There too, this is the world's worst investment opportunity as a liquidity provider because it would instantly be gobbled up by arbitrageurs. So the common sense observation that the AMM cannot yield better than the market translates into the mathematical requirement that the curve has to be convex. So basically, if you filled the curve with water, it wouldn't spill. The next thing we want to say is that we don't want to build in assumptions about the price. So remember, the spot price is the slope of the tangent line. So we want to say whatever price happens, we have a point on the AMM that will deliver that price. So that says that the tangent has to range from infinity. That's what happens as the number of florins get small and the number of guilders get large. That is, we move up the curve and approach the y-axis. And the price can approach zero, which is what happens when we move along the x-axis and the curve gets flatter and flatter. As I mentioned, of course, the price never reaches infinity or zero, but it can get arbitrarily close. So we want the ability to adapt to any market price that says that the tangent has to go from infinity to zero, which means basically that if you put all these things together, the curve has to look an awful lot like the x times y equals 1 curve that I showed you at the beginning. It can change in all kinds of clever and interesting ways, but if you kind of squint and look at it, all these curves are going to pretty much look alike, because they have to look alike, because the shape of that curve dictates the behavior of this particular financial instrument. So what I've shown you here are is basically Uniswap version 2. Nearly everything I've said is essentially true for lots of other competing AMMs. There are minor variations in things. And initially, we expect that V3 will be the kind of the most obvious thing to port. What I'm going to do is I'm going to describe some of the differences between V2 and V3. A lot of these are convenience things, neat things to have, but not terribly interesting for us here. More flexible fee structure, better user interface, and so on. What I'm going to talk about is, I think, a very clever feature, which is worth understanding, called concentrated liquidity. It's a simple idea. So as a liquidity provider, what I'm saying is that I will provide the assets for a trade, no matter what the price. So one way to think about this is saying that if you look at kind of each interval, each price range, I'm willing to cover all of those, and my assets are kind of smeared out over the entire axis here, which I've represented by putting one flooring coin in each range. Now, in practice, if assuming the coin is not super volatile, trading mostly happens in one range. So the price doesn't get higher than a certain amount. The price doesn't get lower than a certain amount. So all the trading is going on here, but I'm paying for coverage everywhere. And in fact, it would be more productive if I could concentrate all my money in a particular range. So concentrated liquidity says I can take all my assets and put them to work within a certain price range. So that says that you can have access to my florins, provided the price of florins lies between a minimum and a maximum. And as long as that price is in that range, I want to be part of the deal. I want to collect fees proportional to the amount of liquidity that I have. So I basically multiplied the fees that I'm going to get by 4 by concentrating my liquidity. So with the same investment that I had before, I can earn a lot more as long as the prices stay within range. And for many coins, this is a reasonable bet. You know that the price of Ethereum is unlikely to go below 1,500, unlikely to go above 3,500. And as long as we're in that range, then I'm willing to concentrate all my money there. I should mention that there's a downside, that if you're wrong and the price leaves that range, then you're not participating anymore and you're not earning anything. So this is a little bit like using leverage, maybe not quite as dangerous. But I'm saying that as long as I can predict the price range correctly, I can make a lot more by concentrating my money. If I'm wrong, then I'm going to lose the opportunity to make money, because I'm going to be cut out of the action. Eventually, I'm sure we'll support even more advanced versions of Uniswap. The current version of Uniswap, which I don't know if it's been released yet, is Uniswap v4, which provides something called hooks, which is user code that you can call when interesting events happen. So I can call user code before I do a trade, after I do a trade, before I invest, after I invest, things like that. And you can use that to build all kinds of powerful, customized instruments. So I can, for example, create something that trades florins and guilders, but only works while the New York Stock Exchange is open. That kind of thing. There's also a bunch of other technical improvements. If you're interested, I encourage you to look at them. They're all, very nice, very clever things, but not something that would fit into this kind of a talk. Okay, so that's what I have to say about AMMs. The advantage of AMMs, they're decentralized in the sense that nobody can steal your money, unlike a centralized exchange which can go bankrupt. You get instant gratification, unlike an order book where we saw you might end up kind of stuck with an order partially filled, waiting to fill the rest of your order. You get a take it or leave it price. If you like the price, you take it. If it's too expensive, then don't take it. The structure is simple and transparent. You can look at the smart contract code. The idea involves basically high school math. There's basically not too much that needs to be understood here. The downside is that in principle, there's front running, and sandwich attack is a variation on front running. Again, this should be a concern if you're a whale trader, but it does not seem to be a danger for kind of normal traders. There is a kind of tension between liquidity providers and arbitrageurs. So the arbitrageurs perform a service by keeping prices accurate, which is good for customers, but the profit that arbitrageurs make comes out of the liquidity providers. And so this implies that if you're building an AMM that trades volatile currency, you probably want to charge more fees to protect the LPs. That's all I have to say. So I'm going to turn things back to Anthony, and you can ask me questions.
Okay, well, thanks very much, Maurice. I appreciate that. It takes me back to school days, some of the maths there, dy over dx and various things like that. So yeah, good to see some of the maths that we covered in school and other times. An observation from my side, I find it quite fascinating when you look at how most of the financial markets work and the order book, and how cumbersome and archaic that seems to feel when you look at something like this, which is has the beauty of maths behind it and just seems so much more simple and almost obvious. But obviously it took cryptos and blockchain and smart contracts to be able to deliver on something like this or implement something like this. And I think people often ask sort of what are the advantages of blockchain over traditional finance, and there are things like this which you just can't do in traditional finance, and there are lots of other good examples, and this is just one of them. Maurice mentioned, and maybe just to give a little bit more color on that. So we are, and it's been mentioned before, we're busy with our core DeFi infrastructure implementation. So that covers core DeFi, which would be things that are needed to run DeFi indexes and oracles, and then things like stable coins, DEXs. DEXs run on AMMs, so that's effectively what it is, which is a decentralized exchange. Other things like lending and borrowing, those sorts of services, and then also bridges as well. So we're busy with that. So we'll certainly have Uniswap v3 variants on our chain, not just provided by us, but obviously the community as well. And there's a lot of interest and people that are starting to build those on our chain. So this is all very relevant to us. So it's certainly useful to understand under the hood how they work. I think on that note, we're going to open up for questions. While we're doing that, I'm just going to pop up a survey. It's a couple of topics that Maurice could talk to in the future. So if you can vote in terms of which ones you are more interested in, you can pick all of them, just give them a value next to them in terms of your interest level, and then we can schedule a couple more of these. I think they're very useful, very informative, and it's a nice break for me from having to do a traditional AMA and rather talk about interesting stuff in the tech itself. So let me open up for questions. Okay, Maurice, easiest if I'll just read questions as they come through, the ones that I think are most relevant. So besides Reed saying, thank you very much, Maurice, otherwise from J. Rook, no one can steal your money on a DEX unlike a centralized exchange. However, what mechanisms prevent individuals from manipulating a token's price on thin DEX liquidity pools?
Well, manipulating a token price can be expensive, and there are kind of boundary cases where people have done that, say by taking out flash loans and so on. But typically, if you can manipulate a price on a centralized exchange, then probably you don't need AMMs to make money. You could just do arbitrage right there.
Okay, thanks for that, Maurice. Okay, there are a couple of questions which are sort of off topic. They relate to BlockDAG and mining and various other things. So if you can keep them on topic, we'd appreciate that. While we're waiting for other questions, I've got one or two as well. It might be, there's probably a simple answer, but is there a reason why centralized exchanges can't or wouldn't use AMMs?
Centralized exchange could certainly, anybody can use an AMM. So, I mean, I can set up an AMM, fund it myself, get my friends to fund it. A centralized exchange could certainly be a liquidity provider in an AMM. They probably get better fees by charging directly than they would through an AMM. But there's certainly nothing that would prevent Coinbase from setting up business behind an AMM.
Okay. Another question from Leave. What relationship would staking and LPs have? How would staking impact liquidity pools?
So that's a very good question. I've seen proposals where you could simultaneously stake something and put it into an AMM. These tend to get fairly complicated because if I'm getting staking revenue from a particular coin, I put it in an AMM pool. What happens to that revenue if that coin gets traded to someone? So so these coins become non-fungible. It's still a kind of an attractive idea that many people would like to be able to both get staking fees on their coins and invest them simultaneously. But figuring out exactly how to do that is tricky, and this is something that is a very active area of current investigation. And I think if you can figure out how to do that right, you should set up a business.
Okay, thanks. I mean, that to me obviously sounds a bit like leverage, as in you probably doubling up your risk, but obviously hopefully doubling up or more than doubling up your return. Another question on the size of the liquidity pool. So I'm just going to summarize the question. So obviously, depending on the amount of liquidity in the pools will dictate how fast that dot moves along your line. I mean, what's the guidance around how much liquidity needs to be in there for it to operate and not to be sort of too thinly traded or have too little liquidity?
From the customer's point of view, the more liquidity in the pool, the better, because that flattens the curve, which also reduces the slippage. So if I want to do a whale transaction, then I want to find an AMM that has lots and lots of liquidity, because that means the difference between the first price of the first coin I buy and the last coin that I buy will be less than it would be. So adding more liquidity takes that curve and moves it further and further away from the axes, at the same time that it flattens it. So pretty much, if you're looking for an AMM to do a trade, one of the first things you should do is consider using the one with the with the highest liquidity.
Okay, thank you. Impairment risk, is that what you explained earlier, or is that a different risk that you haven't covered?
Payment risk. So payment risk is
no, sorry, not payment. Impairment.
Oh, impermanent risk. Okay, so impermanent risk is a word for the risk of loss that the liquidity providers undertake. So, or impermanent loss, I think. I hope this is the thing that the questioner is asking about. So the fact that the liquidity providers can lose money if the prices shift is often called impermanent risk, which is a kind of a weird name, but it just means that the liquidity providers would really like the exchange rates in the centralized market to be the same at the end as they are at the beginning.
Okay. I find it's quite interesting that some of the risks that you talk about coming from traditional finance exist here as well. Things like front running, obviously arbitrage is not a risk, but it's so a lot of these concepts are actually shared with traditional finance as well. There's another question from Samuel. He's asking whether BlockDAG will only provide the X times Y equals constant formula, as in the V3, or whether we'll support more advanced models as well. So, Samuel, that's at this stage, we're implementing V3, which gives you that standard formula. There are obviously mechanisms in there to change that up. It'll also depend on who else implements what versions on us. So I think for now it's difficult to answer that. So yeah, I, to be honest, don't know enough about what we're doing technically to answer that myself. I'm not sure, Maurice, if you've got an answer to that.
Well, I think if you want one, it wouldn't be too hard to build one. So you can go in and modify the smart contracts of an existing constant product to make it anything you want. You want to make sure you know what you're doing if you do that. But pretty much on more established blockchains, you can find all kinds of variations of AMMs that people can do. They typically have a fairly modular structure, so I don't think it would be rocket science for someone who knows a bit about AMMs to go in and put in other binding curves, other formulas.
Yeah, so V3 does support concentrated liquidity, but in terms of other binding curves, as Maurice said, I'm sure as depending on who's implementing the DEXs and also what the demands and requirements are, those certainly will materialize as well. Sorry, actually, I'm just going to enable the poll as well, if you can vote in terms of what everyone would like to see in future sessions. And then while that's ongoing, we'll just see what other questions come through. Okay, I think so. So there are other questions here, but they're not related to the topic, so I'm going to skip those. Couple of people saying well done, appreciate the presentation. So I think that's good to hear. Thanks for that positive feedback. Okay, so the votes are coming in. I'm actually not sure if everyone sees what I'm seeing. If you don't see it, Stablecoins 101 is leading the race at the moment. but otherwise all of them are getting votes. So I think there's general interest in all of these, but we'll let this go for a little bit longer and see what everyone's preference is. Okay, seems like everyone's happy. No more questions. So Maurice, I think we're done here for the evening. So yeah, from my side, I just want to thank everyone very much for attending. Always good to have you here. As I said, we'll follow this up probably with a session on stable coins and then other topics as well. And we'll try and keep the cadence on these sorts of sessions probably every 2 to 3 weeks. So we'll be speeding things up a bit. So yeah, thanks very much from my side, and Maurice, thanks very much for presenting. It's always good to have you on here. You certainly take what tend to be quite technical and complex topics, and you certainly deliver them in a way that's easy to understand and digest. So thanks very much for that.
Thank you, and thank the audience for your attention.
Okay, great. Thanks very much, everyone. Have a good evening or day, depending where you are. Until next time, goodbye. Cheers.